Germany's parliament approves a huge spending surge, but will it be enough? Germany looks set to create a €500 billion infrastructure fund and ease the debt rules in its constitution to allow for more spending on the military. Over 1% of GDP, that will be exempt from the debt brake. The package passed the lower house of parliament on Tuesday. Well, Carsten Brzeski is global head of macro at ING Research. Carsten, we spoke before the German election and you told me the new government would need major fiscal reform. Have they gone far enough?
Well, not on the reforms yet, but on the spending, definitely. I think this is a positive surprise, and it has been a historic week, or actually historic weeks for Germany. And just to really put this into perspective, the constitutional fiscal debt brake had been around since the financial crisis. It used to be really the trademark of many governments under Angela Merkel. Changing this now is historic, is enormously important for German economy, but actually for the German society. And by now really spending 500 billion euro into infrastructure that has been deteriorating over the last decade, extremely important. Also spending more on defense, clearly geopolitically extremely important. The structural reforms, we still have to see about it because we only will get the coalition talks going now. And it really then will depend on the outcome of these talks, whether we can really be fully satisfied with the outcome or whether there is still some room for improvement.
What reforms then do you think are now most necessary?
And I think we need reforms that are going to boost innovation, that are gonna boost also really business activity. Because the good thing about this infrastructure spending story is one that it really will modernize the German infrastructure, including digitalization. So that is important. But of course, if there are no really strong companies, if Germany no longer has strong products or services, well, what is a modern infrastructure really worth?
Do you think the investment in itself will give much of a short to medium term boost to an economy that has, of course, been really in the doldrums for a couple of years now?
Definitely. It will depend a little bit on the outcome of the coalition agreement to also get a psychological boost. But just looking at the numbers, we know that infrastructure spending has a multiplier of around 1. So really, every euro you spend on infrastructure should more or less also really go into the real economy. That is a positive one. It would boost construction sector, developing sector. It would then also, once we have a functioning infrastructure again, it would clearly also help the big multinationals, because Germany, being in the middle, in the center of Europe, is also a logistical hub. So if there are more efficient transportation means, it would also benefit the entire German economy. So infrastructure can really be a quick gain for the economy. To the contrary, when you look at defense spending and the increase in defense spending, that, in my view, is rather a slow burner.
Carsten, the other big headline, of course, today is central banks. The Fed later today, the Bank of England tomorrow, and the Bank of Japan earlier, which of course kept rates on hold. The others are all expected to follow suit. What implications does that have for the global economy if they deal with the Trump uncertainty by staying put for longer?
Yeah, Ellen, I currently always have to think about what the former ECB president Mario Draghi said, I think in 2019, when he said that we are currently in a dark room, and in a dark room you only move very slowly in tiny steps. And I think this is the reality that all central banks are currently facing, and this also explains why they are slowing down their efforts to cut, because they, more or less speaking, I think across the world, most central banks are at the upper end of whatever we would call a normal or neutral interest rate. And they are now really waiting for the impact from the trade tensions for their economies to understand how they can react. And in case of the US, this makes sense. Also, in case of Japan or the UK, it makes sense, and it will also make sense for the European Central Bank, which will only meet in April again, because in Europe itself we now have really two very opposing factors. So one is the positive part we just discussed, German fiscal stimulus, European defense spending, that would argue against further rate cuts in Europe. But then on the other hand, we have the looming tariffs on European goods, which could be a motivation for the ECB to continue cutting rates.
That was Carsten Brzeski of ING Research. Don't forget, you can watch more videos on Reuters.com.